and welcome to Bloomberg Quint. You're watching The Fine Print. This week, the Lok Sabha cleared the Finance Bill 2018, but with some tweaks to the version proposed during the first part of the budget session. Among those tweaks, the most important one relates to long-term capital gains tax for unlisted shares. Remember, on the sale of listed shares, effective April 1st, a 10% tax will be applicable on capital gains exceeding 1 lakh rupees. Gains up to January 31st this year have been grandfathered, that is, they won't be subject to tax. But the Finance Bill provisions did not spell out the fate of shares that were not listed as of January 31st this year and are listed after the long-term capital gains tax becomes effective in April this year. That clarity has now come in the form of amendments that have been cleared by the Lok Sabha. But how useful is this clarity? To answer that, I have with me Amrish Shah, who heads the M&A tax practice at Deloitte India, and Prakash Nene, Managing Director of Multiples Private Equity. Gentlemen, welcome to the show. Mr. Shah, the amendment relates to Section 55 of the Income Tax Act that lays down cost of acquisition for capital assets. They've added a provision here to calculate capital gains for shares that were not listed as of January 31st, 2018, but will see a listing once the long-term capital gains tax provisions become effective. Before we come to what the new provision is, could you give me or could you throw some light on why we needed this clarity or this new provision?
So if you just go back and go to the budget which was presented, it did talk of two categories of assets where fair market value was provided to be calculated as on January 31. One was the listed shares and one was units. However, there was a missing gap for the unlisted shares. And if you see 2017 and the start of 2018 and the number of IPOs that are happening, how do you calculate, the fair market value of unlisted shares which get listed after January 31, 2018? I think that's the gap which they've tried to now, provide clarity on through this amendment.
Okay, so now they've said that the fair market value of shares which were not listed as on January 31st, 2018, but are listed on the date of transfer, the fair market value will be indexed for the period up to financial year 2017-18. How will this work?
So the proposition that they have put down is what is the cost of acquisition of those shares. I go back to that year, do indexation for 17-18 and calculate that as my fair market value. So to that extent, they have given an indexation benefit. Well, let's say, just take an example that I had an unlisted company which was incorporated in 2006 and therefore the promoter is holding the company or from that day onwards. So the cost inflation index of that year, 2006, and the cost inflation index of 17-18 is what the indexation benefit will be provided for while calculating the 10% capital gains. So that's the leeway that they have provided.
Okay, so to that extent, the cost of acquisition will become higher after accounting for inflation.
So it will be, the acquisition cost will be increased to that extent.
Okay.
And therefore your capital gains will get reduced to that extent against your consideration when you sell those shares.
Right.
So if you look at any IPO which is going to come in the next few days or which has come after February 1, and if somebody wanted to sell those shares, then that will be an applicable thing if you were already holding it prior to the IPO.
Okay. Mr. Nene, there were several representations from what I can remember that were made after the budget's proposals were put out to say that there should be a fair market value replacement up till January 31st, 2018, and that should be then the basis of calculating my capital gains if I see a listing after that. That hasn't happened, right? What to your mind will be the impact on promoters like Mr. Shah said, who were planning for an IPO, some of which are in the works, right? They're filed with the regulator and preparing to debut. The impact on such promoters and private equity, investors as well.
Yeah, so let's talk first about the private equity investors. Now, private equity investors who are based out of, say, Mauritius or Singapore, and who had the treaty protection, for them, except for the last couple of years.
So April 2017,
yes.
Where till then the treaty benefits.
So for them, this is neutral because they were in any case protected. Thereafter, people who have made investments, now for them, obviously 1 year, 2 year indexation benefits are available, but those are hardly any benefits because primarily when private equity invests in a place, they are looking at 30, 40, 50% per annum kind of a growth, and an inflation indexation is just 5%. So it is not very material from that perspective. Now coming to promoter, and that's more critical even for us, because if we are invested in a company and we would like the promoter also to cooperate and come for an IPO, we have to make sure that he doesn't have to pay a lot of tax. But take example of promoter who is invested. Now he has started business from scratch, started business from zero, say around 5 years, 10 years ago. And for him, the value which is today, and his cost of investment may be say just 1 crore, but the value of that company today may be 500 crores. So for him, giving 5% inflation indexation or around that for even 10 years doesn't make much difference. I mean, that 1 crore will become maximum say 2 crores, and so he doesn't get any benefit. So we were expecting that if the benefit is to be given, then you have to do fair market valuation, whereby for other places, I mean, tax department has given certain methods like DCF and all. So you do a fair market value on 30%, which truly is the value at which he's sitting today. Then that would have been really a big difference maker. But that's not the way it is. And one more clarification, maybe Amrish can help on that, is I know some of the investors, the promoters are sitting there from say 95 or 90. They've started company there for 20 years, they're making. Now for them there is an option given that in 2001 valuation you can take. Now what would be that 2001 valuation? Because at least that valuation will be a significant up above their cost of investment. To some benefit they will get. But so I would say it is of limited benefit to us and even for the promoters, unless it is a recently invested company, and then I don't find this of much use to us.
Okay. Mr. Shah, do you want to add in there? Because I think there is an option given between the indexation benefit or the value of that company as of April 2001.
No, but I think if you look at the language that has been proposed, it still talks of cost of acquisition, but it only gives you the inflation index right from 2001 to now.
Yes.
It doesn't say fair market value as on 1/4/2001 and then you index it.
Absolutely.
So if you look at any other asset than this, suppose I was holding unlisted shares and I did not want to have listed shares, then this 112A and the 55 whatever amendments fair market value do not come into play. I would have got a 1/4/2001 fair market value based on whatever methodology that one can use, which is fair. I would have then taken indexation on that, from that day onwards, which may be higher than my cost, which was the 1990 cost or 1995 cost, as Mr. Nene, just articulated in the example. So I think that's the danger there. So let's look at a promoter who has, started a company in 1995. He is going into IPO, and let's say his IPO is going to come out in July of 2018. Generally for 1 year they will have a lock-in. He will sell the shares in, let's say, August of 2019. He wants to sell 5% of his shares. Now if I look at that scenario, he can index only from 2001 of the cost that he is put down in 95 up to 2017-18.
Okay.
So what happens is he is holding the shares till August of 19.
Right.
He is not getting indexation for the first 6 years of his investment.
Right.
And he is not getting indexation for the last
1 year.
1 year or plus.
Right.
So he is losing out at both ends.
Right.
But that's the way the law is.
That's where the clarification may be required, that the first 6 years where the benefit should have been given somehow inadvertently, how to calculate that fair market value in 2001 is something a clarification is required.
Yeah.
And just want to add a quick one on the, you took a situation where he is selling after 3 years, but I am saying there are a lot of companies who are getting to go into IPO in next 2, 3, 4 months. Now, I remember that under earlier section when the STT things were exempt 1038, there was a notification that even if the STT has not been paid when at the time of acquisition, now these all unlisted companies, no STT has been paid, it was still exempted,
So
and
they
there
had
was no
exempted
tax.
several
Now they have said now that we will come out with a notification, but my point is that we should come out with a notification in the next 1 month, 2 months. Suppose like last time the notification comes somewhere in June and July. So people who are wanting to do an IPO between April and June, what are they going to do? So that's another issue, and that's a live problem which some of my friends have already explained to me.
So there is another danger, is you are getting inflation index only up to financial year 17-18.
Right.
Look at a scenario where I want to sell the shares in 2020. for the cost purposes, my inflation index is stopped at 17, 18.
Right.
It's not going beyond 17, 18. So March, I mean, that's the last year of indexation. So if you have a higher inflation index next year, I don't get that benefit, even though I'm holding that stock.
Okay. So let's, come to the second limb of this indexation benefit, and that will be applicable to unlisted shares which are substituted for tax neutral transfers under Section 47. Mr. Shah, you want to give us some background on why this clarification was needed?
Yeah, again, I think if you look at the provisions of 112, the way they have come in, it talks of transfer of a listed share. Now, it could well be that I have got those listed shares post January 31, 2018 as a result of a merger, and that merger could have been of an unlisted company into a listed company. So, do I get the fair market value replacement as on 31st Jan? And I think it is to cover those situations. They are saying that we will go back to your unlisted shares. We will go back to the formula that they've given for the cost inflation index as on January 31 and give you that benefit while calculating your capital gains, even though your share was not a listed share as on 31st Jan 2018. I think that's why they have brought in, and it's not only merger, but a gift or anything else which is covered under those exemption provisions is what they have brought in here.
Okay, so let's say convertible securities, mergers, demergers will all get covered under this?
Absolutely.
No, yeah, there is one, I know some live situation, and that's also I'm not very clear. Maybe Amrish, you can perhaps help me on that. That there are situations where you are in a say listed company which is having an unlisted subsidiary, and you are demerging the unlisted subsidiary in lieu thereof getting shares in the unlisted subsidiaries. Now, those situations are live situations in many situations. So once you get the shares of those unlisted subsidiary which you are getting after 31st March, January, what is going to be the tax treatment? Because your shares in the listed entity are getting extinguished. In lieu thereof, you are getting shares in another company which is unlisted, which is going to be listed.
Right. So again in those cases of whether it is a listed merging into unlisted, whether it is going to be listed into a listed, I think the budget amendments or these amendments do not provide for any clarity in terms of the fair market value replacement as on 31st Jan. What I expect is that when they come out with this notification exempting the acquisition related STT, they will also have to provide for a formula like how they have done for unlisted companies, maybe through that notification, because otherwise the problem that I see there is I might not get anything as of 31st Jan in those companies. And then what happens, and can I then I mean, I always have this, that if the fair market value computation mechanism or cost of acquisition computation mechanism fails, can I say there is no taxation, having regard to the Supreme Court decision?
Yeah, that will be a brave position to take.
No, yeah, I agree. But if somebody wants to litigate,
right,
and see, because there is a proposition of the Supreme Court on this point, how valid in the current circumstances and all, one can keep on arguing. But this is a genuine case, and I would think they need to come out with that clarification simultaneously with this notification. That
because I think the FAQ also that the tax department had published post the budget sort of provision didn't cover any of these situations.
No, they covered couple of situations, which is right shares and bonus shares,
right,
and how they will be dealt with.
Right.
So if you had rights or bonus prior to January 31, 2018, you will get the fair market value replacement as on 31st January 2018, and if it is after that, anyway you don't get that replacement possibility. But they have not covered all the situations.
Okay, I do want to just go back to my question on the treatment to unlisted shares and maybe ask what kind of activity can we expect as a result of this provision in the coming months?
Actually, in fact, we are witnessing a large number of IPOs hitting the market now in the month of March, maybe February also. It's picked up real pace, and if you see now, at least I see at least 5-7 IPOs coming every week, and I think that's going to expect, especially where there is an exit for the promoters. I think those will be the ones which they may want to cover before March 18, because they have a favorable treatment till then, and the treatment will change from April 1, 18 if they were to do an IPO at a later date. So I think that clearly is evident as of now. So
last word to you on that whether the expectation was on fair market value replacement, that hasn't come in, but this indexation benefit to your mind will sort of cushion some of that fall.
Yeah, so it's a halfway street, I mean, if I can put it that way, because it does cushion, but cushion only till FY 17-18, and not beyond that. So I think that's the sort of mid path, I think, which is being taken. I think the other important element is on the notification. I think at least this time, at least what I have picked up is that they're likely to do more like April and early May, because last time I think it was the first time for them. At least now they know what they need to exempt, so it's just a repetition. Maybe they have to cover the formula for certain of the cases which can fall within the provisions that are being there. So I think that's the only addition that they need to do to the notification.
Well, hopefully the government moves faster this time around. Mr. Nene, Mr. Shah, thank you for joining us on the Fine Print today and throwing some light on what these provisions means for promoters and private equity investors.